Wall Street just had its best week since April. But here's the paradox. Part of the reason stocks rallied was because the economy delivered some genuinely weak news. Now inflation gets the next vote. Let's get oriented. I'm Lazar Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for Monday, August 10th, 2026. Markets enter the week near record territory, but the story has changed. Investors spent much of the summer worrying that persistent inflation could force the Federal Reserve to raise interest rates again. Friday's employment report challenged that assumption. The question now is whether weaker hiring represents the controlled slowdown markets wanted or the beginning of something more concerning. And what a week it was. The S&P 500 gained 3.6%. The Dow rose 3%, the Nasdaq jumped 5.2%, and the Russell 2000 gained 3.5%. The S&P finished Friday at a record 7,757, while the Dow closed above 54,000. This was not simply a mega cap technology rally. Participation broadened into small caps, industrial, software, biotech, and other areas of the market. But Friday proved the biggest catalyst. The economy unexpectedly lost 23,000 jobs in July. May and June were also revised lower by a combined 103,000 jobs. The unemployment rate actually fell to 4.1%, but labor force participation declined to 61.4%. That matters. Markets interpreted weaker hiring as reducing the urgency for the Federal Reserve to raise rates again. The 10-year Treasury yield fell to about 4.64%. The dollar weakened, and gold surged roughly 7% for the week. Oil moved in the other direction. Brent finished near 83.55, down about 5% for the week, while WTI fell nearly 8% as markets priced the possibility of progress towards reopening the Strait of Hormuz. And that brings us to this week's thesis. Markets are trying to price a soft landing inside an economy that is sending conflicting signals. Manufacturing expanded strongly in July, with the ISM manufacturing PMI reaching 55.6. Services remained solid at 54.1, but job openings declined. Private sector hiring slowed, and the official employment report showed outright job losses. So remember this distinction. Market expectations are not actual economic conditions. A weaker jobs report may support stock prices because it reduces interest rate pressure, but continually weakening employment would eventually become a problem for earnings and consumer spending. That's why this week's inflation numbers matter so much. Wednesday brings the July CPI. Thursday brings producer inflation. And Friday brings July retail sales and preliminary consumer sentiment. Think of these reports as three pieces of the same puzzle. CPI tells us what consumers are paying. PPI tells us what businesses are paying. And retail sales tell us whether consumers are still willing and able to spend. If inflation moderates while spending remains resilient, the market's soft landing narrative gains credibility. But hotter inflation would put rate hikes back into the conversation, and materially weaker spending could shift the concern from inflation toward growth. While macro data sets the backdrop, earnings will show us the real-world impact. CoreWeave reports Tuesday, Cisco on Wednesday, and Applied Materials on Thursday, giving investors another look at whether extraordinary AI infrastructure spending is translating into sustainable revenue and corporate profits. That matters because markets are no longer rewarding AI spending simply for being large. Investors increasingly want evidence that the capital being deployed can generate durable returns. And then, there's the one major geopolitical risk that cannot be ignored. Negotiations involving Iran and Oman over shipping routes through the Strait of Hormuz have progressed, but reopening the waterway remains unresolved. Over the weekend, Iran reiterated additional conditions, while new attacks involving Houthi forces and Saudi energy infrastructure reminded markets that the energy supply chain remains vulnerable. The transmission mechanism is straightforward. Escalation can push oil higher. Higher oil can raise transportation and production costs. These costs can feed inflation, and persistent inflation can complicate Federal Reserve policy. So falling oil helped markets last week, but stabilization is not normalization. So what does this mean for you, the investor? For investors with a higher risk tolerance, improving breadth is constructive, but strong rallies can create the temptation to chase performance. Position size and diversification still matter. For investors with a lower risk tolerance, this is not a reason to abandon discipline. Quality, diversification, appropriate fixed income exposure, and adequate liquidity remain important when economic signals are conflicting. The objective is not to predict Wednesday's CPI numbers. It is to have a portfolio capable of functioning whether the number surprises higher or lower. As we head into the week, I'm watching three things. First, whether CPI confirms that inflation is cooling. Second, whether retail sales show the consumer is still holding up. And three, whether developments around the Strait of Hormuz keep oil contained or bring the energy risk premium back into the market. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.